The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to our webinar, May the 30th. The topic for today's webinar is trade credit insurance, and our presenter will be Brad Forsythe. I want to remind everyone that questions are welcomed. You can submit your questions by simply typing them into the box on the screen and sending them, and we will attempt to answer all of them during the webinar. We will again be offering CPE credit for the program, and as such, we will be giving CPE codes 3 times during today's presentation. If you would like to receive the CPE certificate, take note of these codes and return the completed CPE form to Lynn Keenley in our office. Brad Forsythe is affiliated with Kinker-Eveleigh Insurance Agency in Cincinnati and also chairs the CEO roundtables in Cincinnati, serving over 180 CEOs. Brad is trained in small business strategic finance by the Harvard Business School and is an honors graduate from Augsburg College in Minneapolis, completing his bachelor's degree in communication. He is a member of the Risk Management Association and the American Risk and Insurance Association. If you own or manage a small business, Brad Forsythe is a good person to know. He is the creator of a practical guidebook for small business, a roadmap on risk management called Bulletproof Your Business. Brad, thank you very much for coming and presenting today, and we're certainly all waiting to hear what you have to say about trade insurance.
Well, thank you, Jack. Appreciate being able to be here today and try to spread a little bit of the gospel about trade credit insurance. It's not a product or a concept that's particularly well understood in the United States. We'll go through a little bit of history here in a minute, and you'll see that it was developed primarily in Europe, where at this point probably nearly half the companies in Europe are actually using this product. But in the United States, it's perhaps about a 7% use rate. So it'll be a little bit of new ground for some of your listeners today.
You know, Brad, trade credit insurance is, being with a lot of gray hair, I remember it much more popular back in the 70s, and maybe through the good times of the 80s and 90s, people didn't get into it. So I'm sure today it's certainly a popular topic.
Whenever the economy is stressed, it becomes increasingly popular. Yeah. So let me go ahead. We'll jump into the process today. And by the way, Jack, I envy your silver hair. We're going to discuss these general topics today: how trade credit can be used. Typically, the conversation starter is pretty typically this issue of protecting accounts receivables, and both on a domestic basis and also on a foreign basis. But because of that feature of trade credit, lots of other interesting things flow down through the process. One of those is surely increasing your borrowing base using assets that you've already got in place. So we're going to be a little bit today like medieval alchemists. We're going to turn lead into gold, and we're going to do that by taking some assets that are considered in many cases to be so risky and so desirable that banks automatically exclude those things from your business's borrowing base. And along with the process, we'll also talk about how you can improve the competitiveness of your sales teams and make your credit operations a lot more efficient. If we have time left, we're going to jump into a little bit of a bonus issue on financing for your business. It's particularly aimed at exports, and that's through the Ex-Im Bank's Working Capital Guarantee Program. Jack probably already gave you enough of a background. I won't spend any more time on this except to say that Kinker-Eveleigh is just about 100 years old at this point, and believe it or not, it's still a family-owned business. Pretty rare thing. And so the family that owns still comes to work every day and puts their mark and their name on the product. So it's pretty interesting to see the level of ethics and business performance that goes on there. It's hard to say when you're actually going to watch this webcast. Some of you may watch this months from now, and things may have changed. So just in realizing that, we have a normal disclaimer to go in place, and simply to say that we're going to try to be really hardly focused on accuracy and timeliness, but some of those things may change over time. So just in case, the disclaimer's there for you. Okay, let's go way up high, 60,000 feet. Let's go very strategically back at this concept and work our way down toward the ground level as we go through the webinar this afternoon. And so why would we care about this thing anyway? Well, the overriding reason is that most businesses have to sell on some form of credit. The old days of saying, hey, pay me cash in advance, that just doesn't work for much of anybody anymore, not even for most American manufacturers and exporting. CFOs have now grown up and populated the entire world, and everybody wants to leverage their cash. So most businesses have figured out how to handle the margin activity to make sure they can handle the cash flow, but that's not the big issue anymore. The big issue is accepting the risk. And so when you're the owner or a partner and you've got, it's your bottom line at stake, can you handle that emotional stress and the financial challenge that will come if you have a large accounts receivable default on you? And so that's the conversation starter in almost every case in this conversation. Simply said, if your customers can't pay their invoices, the insurance policy will pay it for you. So how risky is this concept of selling on credit? Let's just take a look at this risk continuum. If you start on the far left side in the green section, you'll notice that you've got things like cash in advance. Well, that's a sales term, and you can use it, but it's going to be a sales barrier in an awful lot of cases. And so if you want to open up sales activity, you move toward the right side of that continuum. Typically you do. And if you go over until you see this little red ball sitting on top of the line, you see the words open account, below that uninsured. And that's the way that probably 94, 93% of American businesses are operating. That's where they operate on open credit sales these days. It's very high on the risk continuum. There's absolutely no guarantee that you will get paid. So if you wanted to change that fairly simply, you can move it way down on the left side again in that continuum, go down toward that little green ball on the line, and you'll see two types of common sales terms pretty much in the same relative position of safety or lower risk on that scale. One of those is called commercial letters of credit, and most folks, especially if you're an exporter, you're going to be very familiar with those. And you're going to understand that the relative security of a letter of credit, especially if it's confirmed. You'll probably also understand the relative cost of one of those things, because if you have a letter of credit in place on an export sale in some scary country, you may end up consuming 3% or more of your total sale just on that letter of credit alone. It's a very expensive way to get safe. If you were to choose an alternative in the same relative area of safety, that's where trade credit insurance falls in place. Why is it safe? Well, because the insurance carriers will back up their promises to pay. The lowest rated one that I use is rated A- by Moody's and Fitch. The highest rating I use is United States Export-Import Bank, which is rated with the full faith and credit of the United States of America. Even in today's markets, you don't get much better credit than AA+. And so the cost factor compared to a letter of credit, maybe 0.3 of 1 point versus 3 points. So there is a significant cost differential for a relative similar level of safety. So that kind of gives you an overview. We're going to stick at that 60,000 foot level for a while and come back and again ask the question, why do you care about this stuff? Well, because most of us, we'd like to go out and hunt elephants. I mean, isn't it a lot more fun to go out and pursue a large customer than a small one? And there's lots of business efficiencies to be had by dealing with a large customer where we can get a lot of volume flow, really work out the kinks, get systems and things efficient, and really make some great bottom line margin on that. The problem, of course, is a great big customer is an equally great big risk. And what we often see is a cascade of failures. When a large customer fails, it's not uncommon that they take down a great many suppliers with them. Those suppliers were potentially in a really excellent financial condition before the default. But once that big customer fails, many suppliers downstream just don't have the financial strength to withstand the loss of that major AR hit.
Brad, I'm assuming that there were some companies that had trade insurance that were GM customers.
Probably quite a few.
And is there any numbers out there on what kind of dollars were paid out on claims for the GM bankruptcy? And I'm assuming that a lot of those vendors, unsecured vendors, were not paid by General Motors in there.
You know, I honestly can't tell you about the GM product. I actually didn't have any customers covering GM.
Oh, okay.
So, unfortunately, it's one thing I skated. Well, fortunately, I guess it's one thing that we managed to skate past.
Yeah.
But we've seen some other interesting things happen, like, for example, the Arab spring, and we'll talk about that in a minute, how that affects people as well. But simply said, again, when a large customer goes down, it's not uncommon that they take many people with them. It's that cascading factor that makes things kind of scary sometimes. And the other thing, of course, is let's just get back to the issue again of a CFO's perspective. I'm suspecting we've got many financial-related people watching this webinar today. And people simply want to leverage that cash. And so if you can afford the cash flow and if you can find a way to manage the risk of offering open-term sales, your odds of converting prospects into customers are vastly higher. And, of course, the same thing everybody else wants in sales. Then you have also much greater opportunity to take those customers and increase the frequency and the size of their orders. A little bit of history about this. The earliest instance that I can find about trade credit insurance goes back to shortly after the American Civil War. So this has been around for a long time, despite the fact that in North America it's relatively unknown yet. The really big development for this happened after World War I, when the economies of Europe were just devastated. And so people were trying to come out of that war, rebuild economies, rebuild businesses, and companies simply didn't have the ability to put cash in advance to buy goods and services. Something had to be developed to continue, let those economies continue to grow. And so trade credit became one of the real stalwart performers for that whole process for regenerating Europe. And it continued on quite well through Europe for many years until the 1990s, when a really significant wave of consolidation hit. And that's when you find what you'll see at the bottom of the screen. Most of the entire world's market is now covered by 3 companies. One of these companies alone is so large that this year it will cover about 1.2 trillion, and that's trillion with a T, folks, dollars worth of sales for selling on a worldwide basis. That's an enormous company. Interesting note on the side, these companies are also 3 of the world's largest commercial collections companies. And they go hand in hand. We'll talk about that a little bit more as we continue down the slides. Now, those 3 names you'll see also on this screen. We use all 3 of those companies to cover what we call the short-term market, or trade credit insurance that's targeted at sales that are less than 1 year in payment. We also work with a company called FCIA to work with medium-term things. So if somebody has a trade credit need, but that payable may be paid over 5 years, then we can also work with that kind of a product through another company. But this is where most of the market will sit. We also have we really like to help businesses get into the export business. And the lowest risk, probably in many cases, one of the highest value places that they can possibly go is to the Export-Import Bank of the United States. And so we've deliberately gone on to the process of becoming a broker for them as well. We'll talk a little bit more about EXIM later, but I know that it's a part of the federal government, and sometimes business people are a little uncomfortable about saying, hi, I'm here from the federal government, I'm here to help you. I'll tell you it's really true in the case of EXIM Bank.
They are here to help, and I've seen them help in many ways in terms of working capital and relating to companies that export. So
I'd like them very much. Let's stay at that 60,000-foot level, and let's take a look at this now from a CFO's perspective. A CFO is constantly on the money hunt. And so a CFO would commonly be looking at this asset pie chart here and saying, yeah, that looks about right. You know, if it's a normal company, probably about 40% of their assets fall into that big red slice of the pie. Now, if you're a heavy services company, like my former company being a major league international marketing business, 85% of our assets were accounts receivable. Mm-hmm. And so that becomes a real problem when 2 types of accounts receivable are almost instantly excluded from your borrowing base. And I suspect that most of your viewers today understand the concept of a borrowing base. A borrowing base is what a bank is going to look at as far as being eligible assets that they will consider advancing money to you on a line of credit. Now, they almost instantly and automatically, virtually without exception, simply exclude exports. So despite the fact that everybody's telling you these days you need to get into exports, there's a problem there, which is the more you export, the more cash pressure you're creating yourself because you can't add that into your borrowing base. So we need to find a solution for that. And the other big thing is, if we're out hunting elephants, we get some really big customers. Banks become very uncomfortable with the concentration of that accounts receivable risk in a few big eggs in your basket. And so they will discount substantially their willingness to borrow or advance against those large concentrations. And so we need to find a solution for that, and that's one of the big benefits of trade credit insurance. We'll talk about that on the next slide. Okay, we're coming down. We're zooming back down toward Mother Earth. We're down to 30,000 feet now. So a little more nitty-gritty. Very simply, if you cover customers with trade credit insurance policies, and those customers either become bankrupt, or perhaps they're not technically bankrupt, but they are insolvent to the point they cannot pay your bills. The insurance company pays those bills for you. Because of that, banks look at this AR and say, whoa, this is good stuff. I don't know any assets that you've got in your borrowing base other than cash that are any better than paper backed by a AA+ credit rating. So all of a sudden, assets that were simply excluded from your database, or from your borrowing base, are put back in and advanced against at a very high rate.
Brad, I have a question, and it may be something you're going to get to later on, but the term slow pay, if you have a slow pay, I assume that to mean, okay, your standard terms are 30 days and you're out somewhere past 120 days.
That's very slow pay.
Okay. Yeah. At what point will the insurance company step in and say, okay, I'll pay you for it?
Well, we'll get into that in great detail a little bit later. But it's a really good question, and the answer is about 1 or 2 slides away, and it can be fairly complicated depending upon where in the world that slow pay customer is located. So
got it.
We'll dig into that.
Okay.
So again, because of the fact that the AR is now covered by great carriers, banks put this back into your borrowing base. We'll talk in a little bit about how you can get past this very uncomfortable problem of going to customers and asking them for financial statements. Typically, if you're going to be extending credit to a customer, you're going to want to know who you're extending credit to. And it's a complicated process. It's often very emotional. When you've got a sales VP on your door and you're the credit manager, the sales VP says, I need this sale to make my year, there's a lot of pressure on you. So how can you make a sale very quickly, help them make a sale quickly, and understand the kind of credit risk that you're really asking the company to take on? We'll talk about how you can do that literally in some cases in seconds. And we'll talk about the fact that this worldwide collections that we talked about also plays a role in this whole process of trade credit insurance. And what you end up with is this little line at the bottom. You end up with a remarkably complete credit management toolkit. So if you're a credit manager or a CFO, this is pretty interesting tools here for you.
Brad, I'd like to interject the first CPE code, and that first CPE code is the number 35.
Okay, heading back down toward ground again, 15,000 feet. So let's say that you sell something to a customer in Detroit. So let's stay domestic for the first part of this conversation. Everything domestic inside the U.S. If that customer goes bankrupt, then you would file an insurance claim. And depending upon the insurance carrier that you chose, because they all pay at different time frames, it's an individual choice to make sure you understand when you pick a carrier what that means, among other things in payment time. Let's say you pick one that pays in 60 days. In that case, within 60 days after filing your claim, you're going to get a check. You're done. You're out of this whole mess. Pretty quick and easy. Now let's say that customer in Detroit haven't filed, they're not bankrupt, but they simply don't have the money to pay you. Your invoices are now delinquent. You need your cash. They've got your goods. You're not going to get them back. So you file, again, an insurance claim. And again, within 60 days, you get paid. Now let's take that customer and move the customer to Dubai. So now we're going overseas, no longer domestic. What happens? Bankruptcy is almost exactly the same thing, virtually no difference. Slow pay, it could be different. Why? Well, because there are things like international trade compacts between the United States and other countries that in some cases even state how many days must go by before we can declare a customer in their country to be delinquent. There's also the questions of how fast can you move money through financial systems in different countries. So median, where's the 80-20 lie? Probably getting paid in 90 to 120 days on slow pay overseas. What's the worst? The worst we see out there is 360 days. If you even got one of those very poor cases, and by the way, we'd tell you that in advance. We'd let you know, for example, okay, you're shipping to Argentina. We want you to know Argentina has some financial issues, and one of those is the time frame it takes you to get paid on one of these policies. But your bank would also know that you have a valid claim. It's been validated by your carrier. It's not a matter of if you're going to get paid anymore. Now it's just a matter of when. Let's talk about the Arab Spring a little bit. Imagine that it's 19 months ago, and you've just had one of the best months of your career selling product to Libya and Egypt. You wake up the next morning, turn on the television screen, there's the Arab Spring happening in front of your eyes, and you're saying, this might not be a good thing. And if you had trade insurance policies on those customers overseas, simply you're going to get paid, because a claim, a valid claim against one of these policies is war in a foreign country, the nationalization of your former customer by a foreign government, the cancellation of your trade licenses, even things like the inability of a foreign country suddenly to get satisfactory amounts of hard currency to be able to pay bills for American suppliers. So political risk coverage is a pretty marvelous thing for many pieces of the world. It makes you sleep a lot better at night knowing you've got that. So because you've got this kind of protection, and it is protected, again, backed up by companies with such high credit ratings, banks, again, are now going to let you begin to leverage, financially leverage both your export accounts receivables and your AR that's locked up in big domestic sales concentrations. Many companies naturally defend themselves against AR defaults today by using cash reserves. It's not a very good way to leverage your cash. Looking at it from a CFO standpoint, it's better than taking this enormous hit and having no cushion for it. But get rid of the cushion, because it's costing you money, and there's no deduction for it. Not even, at least with an insurance premium, you've got a tax deduction. This thing about improved credit intelligence and early warning. Imagine that you have this customer in Dubai, and you think life is good, but maybe that company's credit is deteriorating, and you don't know about it. Odds are pretty good that insurance carrier, who covers tens of millions of different companies, is literally watching this credit from all kinds of perspectives. And they may send you a warning and say, hey, Jack, this customer's financial situation is starting to deteriorate. At some point, we are going to begin to reduce cover. We need to tell you about that in advance so you can prepare as well. That's a pretty marvelous early warning, so you can begin to defend yourself all the way upstream on buying raw products and planning labor. The last thing on this slide is the issue of court-ordered clawbacks. I'm not sure how familiar all of your listeners will be, but a clawback is also known as a preferential payment. It's something that's happening a lot more commonly in the United States these days. It's beginning to be seen now around the rest of the world. What this means is, let's just say that, again, that you're a credit manager. You've been doing a great job. You've been collecting your receivables, even from some problem customers. And suddenly one of those problem customers is bankrupt. A court-appointed receiver may come into place and say, hey, Jack, you're one of the few guys that got paid from these guys over the last 90 days. We see the potential here, what we call a preferential payment. Here's a court order. We want all of that money back. If that was to happen to you, it's actually a valid claim under one of these trade credit insurance policies. I put that in here because it's the only place in the world that I know of that this kind of protection is available. But if you've been hit with a clawback once, you'll never want to have to happen again. It's a heck of a surprise. So very, very quickly, who needs this kind of insurance? Where does it make sense? Let's just say that you're strictly selling domestically. If you have sales in the United States of at least $2 million, that's where the threshold typically is to begin to make good sense of this. Average customer is bigger than that, but that's the threshold where the logic becomes to play, the economic logic of it. Now, if you're exporting, if you can qualify for the Ex-Im Bank, the value there is so high that literally you can almost find value there from $1 on exports if you want to. I can protect those receivables. Sales concentrations and exports, we don't need to talk much about that, already have. If you're experiencing defaults, if you're writing off accounts, maybe your policy is a lot cheaper than what you're writing off.
One of the points on the earlier screen, talking about, and especially the marriage between, in the insurance company itself, between the insurance and also that they are in the collection business. Do they also offer credit history information on customers? One of the biggest challenges I always found was, we have a new customer, and then finding information. Do you go to the Dun and Bradstreet route? Do you, send out trade references to other people? Do the insurance companies offer that service also?
They do that. One of them does that in two different ways. The rest of them do it in only one way. And let me tell you very quickly about the two ways. That's a company called Coface. And Coface offers that in two ways. One is you can simply go to Coface and buy a very high-quality credit report. And Coface is, if I was going to look around the world and say, who do I look at and really trust for credit reports, the two top ones are going to be Coface, and the other will be a company based in Cincinnati called Kreller, who does only custom reports. There's no database activity going into a Kreller report. I think that's pretty interesting way to go about it. The other trade credit companies won't give you necessarily a credit report, but what they will do is you would go and say, I want to cover this particular customer for this much credit. Can you cover customer X for $300,000 credit line? And they'll come back and give you a yes or a no answer. They won't give you a credit report, but they will give you an answer. Or they may come back and say, we'll cover them for 200, but not for 3.
Mm-hmm.
So, but I do like working with Coface and Kreller on those two report concepts. Let's talk about customized orders here very briefly. If you are shipping goods, whether it be again to Detroit or to Dubai, if the customer becomes bankrupt, one of the things you typically are going to try to do, or if they just don't pay, you're going to try to get your goods back and try to recoup some sales from those. If it's customized goods, there is no value. And so that's almost a no-brainer to find a way to try to cover that. Now at the top of this screen, you'll see two items in red. That's because this is where we see the big hits happening most often. If you want to talk about the 80-20, this is where trouble usually hits. This rare account rechecks. I know of just about no company that on a regular, consistent basis goes back and re-verifies credit for customers once that customer's been approved. So what's the typical sequence? Somebody starts out as a small prospect. You give them a little bit of credit. They do a good job with it. So what do? You give them more credit. It's kind of like the feeder principle. And you get to a point where at some point, perhaps in many cases, many years later, and this is not uncommon to see somebody default, 10, 15, 20 years of a relationship, they simply, their financial condition has deteriorated behind the scenes. You have no way of knowing it unless you're going back and verifying creditworthiness again from time to time. And usually by that time, 15, 20 years later, they've got a pretty big credit line. And this is where we see, that number 6 is where most of the trouble that I see happens. That's it. Number 7, thin margins. I was just talking with a fellow in the metals business a couple of days ago. His margins are about 9%. He had just taken a $36,000 account receivable hit. Well, if you do the math, it's going to take him $400,000 of sales to recoup what he just lost. And so thin margin companies are very much at risk. The rest of these issues, there's not much to really chat about. They're pretty self-evident. Except number 10, it's just interesting. The first time I ever sold a trade credit policy was for a company who was seeking to be acquired. And what's somebody buying when they're acquiring a company? You're looking at future cash flow. And so, well, they were only so comfortable that future cash flow is going to be there. We insured it, problem solved. Interesting perspective. Who can't get this stuff? Well, Jack, if you want to sell rock and roll to teenagers, we're not going to cover you. This is not for consumer sales. This is strictly for business-to-business applications. Okay, we worked our way all the way down to the ground. Now this is really the nitty-gritty stuff here. So what does one of these policies really actually look like? In real life, how does it work? Jack, if you wanted to cover a bunch of customers, I'd come over and one of the first questions would be, what's the 80-20 thing that you've got going on in your business? Who are the really, really big customers that are probably give you that 80% of your revenue? And I'm going to take those names and addresses, and we're going to go back and actually individually underwrite each one of those customers. Why? Because the risk is so high. And on the declarations page of your policy, you'll actually see the name of each one of those customers, and right next to that name will be a number. And that will be the credit limit that you can offer these customers and protect it fully under the credit insurance policy. Now comes the complicated part. If you're a credit manager, now you're into the other, let's do the flip side of the 80-20. Now you've got 80% of your customers that are going to give you, in total, maybe 20% of your business. And this is pretty normal. Most companies have this 80-20 thing going on. And now you've got this administrative headache, this chore of trying to keep track of credit for so many different companies and trying to get it right. Because as a CFO or credit manager, you get noticed every time one of these guys blows up on you. So what typically have we done in the historic model? An insurance carrier would come to you, Jack, and say, Jack, here's a bucket of money. We're going to give you $200,000. This is credit that you can allocate to these smaller customers. And we'll expect you to do one of four things. We'll expect you to check the credit worthiness by a trade credit, a trade reference, a bank reference, your own ledger history with these people, or through a good credit report. And so if you do your homework on these people, we don't even know who they are. We don't care. If one of them blows up, doesn't pay, you file an insurance claim and just show us the homework that you did. And we'll cover them up to some certain level of credit. And that's the way you handle the small guys. That's the traditional way. We'll show you how the new models are working differently here in just a couple of minutes. So, notice the underline on the word when. We expect claims to happen under these policies. We know if you run enough credit transactions, sooner or later, you're going to have defaults. It's not a matter of if. And so when it happens, or, again, if you get into a clawback situation, a preferential payment, you file an insurance claim. This is when the company first acts as a collections. The carrier acts as a collections company. Remember we talked about the fact that it might take you 60 days to get paid. Well, in that 60-day interim, the company is out trying to collect that money. If they can, they'll send you the payment with a small collections fee, and usually it's a pretty advantageous fee, especially if it's international, where you're typically getting a really great savings on that compared to being able to find a credit collections company yourself. That way we'll hit against your insurance policy. But if they can't collect it, this is when they revert back to being a traditional insurance company, and now they send you a check.
And I can tell you that managing collection agencies or companies is a challenge in and of itself also. I find that historically they would start out, hey, we'll charge you 15%, and then whoops, we can't collect it, but we have attorney fees now. And the next thing you know, their fees are just kind of edging up. And so it would be nice to have somebody on the hook that you can rely on and to do it professionally and at an agreed upon price.
Yeah, it's not uncommon doing this on your own. You might find international collection rates between 30 and 50%. Very, very, very expensive. So let's talk about the new model. If you wanted to be able to do extraordinarily fast credit approvals, with the three private carriers that we talked about earlier, again, so Atradius, Coface, Euler Hermes, they all have databases, and I believe that the smallest of the databases in this group of three has 42 million corporate buyers inside that database. 42 million. Yeah, so it's Euler Hermes, their product covers the USA and Canada. Atradius and Coface covers pretty much the entire globe. Literally, you can go online. If you have a sales manager if you have a salesperson out in the field anywhere in the world, they can call you up and say, Jack, I need to know if I can cover this guy for $20,000 US. You can go online in a few seconds, look up that company's name. If they've been followed by one of these carriers, you'll see a number next to the name. The number may say 25,000. That's your limit. You can give that instantly. You type in 20,000 in a box next to that number, hit submit, and it's done. Now compare that to trying to have a sales guy in the field who you look at and say, I don't know if we can cover him, Bernie, but tell you what, go get financial reports and we'll talk about it. If the competitor's walking in a few seconds later and saying, I got the deal, here's the credit, where's that sale likely to go?
Mm-hmm.
This is a huge thing,
Mm-hmm.
and it's just a remarkable innovation in this field. I think this is just tremendous.
Mm-hmm. Brad, let me give the second CPE code, and that will be the number 7676.
I'm going to talk very quickly about the Export-Import Bank. This is a very different approach to trade credit insurance. I think it's a terrific alternative, especially if you're a smaller company, or even if you're a bigger company but you want to begin to put your toe in the water and test this concept of open credit sales. I have some amazing large customers that are looking just to do this. This is how they're testing the waters to see how this works. How this being, again, open terms sales. They're moving from cash in advance to open terms. So if you're a private insurance carrier, your focus is on making a profit on an insurance portfolio. Let's see, we just went back one. Let's see if we can, there we go. Oops, how do we go back? Okay, there we go. If you're the XM Bank, your focus, your mission is to create jobs for U.S. citizens. And so because of that, and don't take this the wrong way, it doesn't mean that these are crazy, risky people. They're not. Hardly the case. But they still may take some longer-term sales and then some higher risks than the private insurers will do. XM Bank has a pretty high mission, creating those jobs, and they will go the extra mile to help do that. By the way, XM Bank does not make silly risks, and so don't think that this is the place to come for wild and crazy stuff. It won't go through here. But nonetheless, they will really go the extra mile to try to help out a company that wants to get a sale made overseas. And they're an extraordinary place for a small exporter to go. Why? Well, because the minimum premium for a private carrier is going to be $10,000. Now, for a lot of companies, that's pocket change. But still, for a lot of smaller companies, $10,000 is a lot of money. And they can go to XM and begin the process of trade credit at XM for literally a few bucks. It's quite a wonderful alternative. And there's some other things that are different about XM Bank. I'm not going to go into those in any detail, but let me simply say that if you qualify to ship under XM Bank, so again, for example, your product has at least 51% U.S. content in it, then it's a great opportunity to go ahead and begin to test the waters on this business. And I want to just very quickly jump into one of the XM policies just to show you what it looks like. They have a program called Express. It's ideal for smaller exporters, and you can cover up to 10 foreign buyers under the policy with a pretty high credit limit per buyer. I mean, that's $300,000. That's a lot of credit. To keep your costs down on this, again, XM Bank wants to encourage you to get out there and create exports and create American jobs. So they will pay the cost of your credit reports to do the credit reviews on those customers. There is no deductible on this insurance policy. And if you have a loss, your losses are covered at 95%, which is higher than most of the traditional market. So it's really some excellent benefits in this Express policy. It's so simple that you can go on xm.gov and you can see the rates actually published out there. So there's no hocus pocus. It's pretty simple stuff. And if you wanted to look at the pricing, if you offer net 60-day terms, the price is 65 basis points. So what does that mean? Well, that means that essentially it's $6,500 and $1 million worth of sales, covered sales. It's pretty simple, pretty easy. And to qualify, the biggest thing again is you have to be an SBA small company. You can see some other things, but again, the big trick is to have that 51% made in USA content. But it's a terrific product, and if I was looking at experimenting with exports in open terms credit, I would be looking at this in a heartbeat. Let's get into the nitty-gritty of what's the reality of insurance, because so far we've talked about a lot of sunshine. So let's talk about not necessarily the flip side, but at least the reality that this is still an insurance policy. So there are some things that you should expect to see, like a cap on the total claims that we paid under a policy. So let's say that you wanted an insurance policy to cover $50 million in sales. You know you're not going to lose $50 million that year. You might lose maybe $1 million. That's pretty realistic, and so you would put some kind of a cap on the policy that would be configured into the pricing and the premiums that you end up paying. But there'll be a cap on the total claims paid. In the case of the private carriers, with the exception of COFAS, you'll often also usually see a minimum loss. And what they're going to typically say is that about $2,500, a loss below that, well, you kind of cover that out of your pocket. Mm-hmm. In other words, they're trying not to have lots of what they might consider to be nuisance claims. Mm-hmm. COFAS has no minimum threshold.
Is that per customer or
per customer?
Okay.
Per customer, yeah. Or per claim.
Okay.
You could have one customer with multiple claims, potentially.
Right.
Potentially. There's a deductible on these things. Again, it's a policy year deductible, so it happens once. It doesn't happen every time that you have a claim. There's coinsurance. So the deductible and the coinsurance are there because the insurance carrier wants you to have some skin in the game. In other words, just because they're going to cover your credit losses, it doesn't mean they want you to get too wild and crazy with this stuff. Mm-hmm. They still want you to kind of be self-regulating. And so you have something to lose in case one of these things blows up. But as you can see, the vast majority of what you lose is going to get recouped. Are there collection fees? Again, yes, we already talked about that briefly. There could be some legal fees. For example, if somebody goes bankrupt, there are some steps that a carrier, a third party, cannot take on your behalf. You must initiate some of those claims and things on your own. You could have some small fees. So I want to make sure that this is my full disclosure page. I want to get it all out of here. And then there's credit authorization fees as well. So as you are asking these carriers to approve credit, they may be charging you $25 for a domestic credit check, for example. So there's pretty much all of the other side, the flip side. So it's still reality. It's still an insurance policy. So how does the money work? Let's take a look at those things we just saw. If you were to have a policy, and we're going to talk about a $5,000 deductible policy, 95% coinsurance, and if your first claim came in at $15,000, your total deductible for the year would be paid out of that first claim. The remainder, you get paid 95%. On the second claim, deductible's already been satisfied, you get paid a straight 95% on that claim.
How do you define a claim? Is it an invoice? Is it a series of invoices? Is it a purchase order? Is it a...
It's probably going to be an invoice in most cases. It could be a series of them. Because just because somebody is late doesn't automatically mean that you would stop shipping to them.
Correct.
At some point, common sense obviously is going to get in place. And at some point, so will the insurance policy. At some point, if somebody is late beyond a certain threshold of time, or in some cases also perhaps beyond a certain amount of money, then the insurance policy would require you to stop shipping to those people. But common sense prevails in this process.
What if we had a customer that is, and maybe this is getting the cart before the horse, but what if we have a customer that we have an assigned credit limit of, let's say, $100,000 for, and we ship to him to that customer in increments of $3,000 to $5,000 to $6,000 shipments at a time, and the bills normally are paid in 45 days. Well, all of a sudden we're starting to see it grow to 60 or 75 days, and boom, we cut it off at 75 days, and the total outstanding to that customer is less than $100,000, and we start pursuing collection at that point in time. Is that one claim, even though it may represent 5, 6, 7 shipments?
It would probably all come down to one claim.
Okay.
We try to find a way to corral it and keep it simple, because you still have this total at-risk amount that's now delinquent, and so that would probably all fall into one claim.
Okay.
In a typical scenario. So this is an important thing to know. There are times when companies' credit is going bad, and we talked about this earlier in the webinar, but let's just go ahead and double check it. I think this is an important thing, again, to make sure everybody is aware of this. If you have a covered customer, or in the language of this business, a buyer, and their credit is deteriorating, the insurance carrier will not ride them down to disaster with you. They will come to you and say at some point, these people are in trouble, we're pulling back, we need you to do the same. And what that means is that they will cover everything that you shipped up to that point. So they're not going to leave you high and dry.
On that.
But going forward, they're giving you this critical warning saying, this is not going in the good direction. we're not going to ride this horse down.
Gotcha.
And so you would like to do the same. Now, if you were to have a situation where you believe that I have a customer that I know is really risky, I know the future is really gray, really uncertain, but I've got to guarantee the credit limit to these folks no matter what. There is a special market out there where I can go to find what are called non-cancelable limits. You rarely find anybody using them, but in the case of extreme high risk, it might be something to seriously consider. I don't want to spend much time on this slide talking about what it's not, except to cover probably issue number 2, which is this concept of trade disputes. Because this is not dispute insurance. In other words, if you have a customer who orders a bunch of blue widgets and you ship them green widgets, that's not a valid claim. You need to make sure that the product that you sell still meets the quality standards, the performance standards that you have said it was going to meet. And so if there's a dispute, the dispute needs to be settled before the insurance policy can come into play. Now, that's a thing that I hear from time to time. It gets an awful lot of noise when I go back and do my research on this, because I do dig deeply into these things. And I talked to the fellow at the Export-Import Bank and said, well, how often does this happen? And he told me, well, last year we had 700 claims that we had to deal with. I said, well, how many of them are disputes? He said, well, he started counting. He got to his third finger and said 3. Okay. And when I ask the same question of the private carriers, what I hear is that it's actually a reality that's less than 1%. It's so low they don't bother to spend any time tracking it. So it's an area that raises concerns. I just want to make sure that we're addressing it right up front.
Yeah, trade insurance is not a replacement. It doesn't mean that you can be sloppy on your commercial transaction paperwork and documentation. Your purchase orders, your acknowledgement of your purchase orders, how you satisfy those customer orders, you still have to dot your I's and cross the T's.
And as an agent, I go through great pains that when we are submitting an application for one of these policies to actually go to the customer or go to the policyholder and do things like gather up their professional credit management processes so that I can show those things to underwriters to show how professional that you are. And what does that do? Well, that tells a better story to these people. It helps you get higher credit limits, higher discretionary credit limits. And in some cases, it helps you get approved where you might not get a policy offered. Just because you apply, no guarantee that a policy will ever be offered. So we've pretty well covered through that process. With the extra time, Jack, we can move into Ex-Im Bank if you'd like to.
Yep.
So let's go ahead and we'll do this very, very quickly. I won't spend much time on this in case we get questions. I'd like people to handle the questions instead. And if you have questions, by all means, please feel free to go ahead and type them in and shoot them off to us here. The typical example here is a U.S. business, and all of a sudden, they've got this website and they got this hit. And somebody wants to buy something. Maybe they hadn't thought much about it, but now they've got this big sale, and they've got to find the cash to be able to produce the goods to sell. And one of the things that might be particularly uncomfortable is this concept of a performance bond, which this guy knows is going to suck up a lot of cash. So what's he going to do? Well, he will probably, let's just say this fellow's already smart enough that he's already working on trade credit insurance for his exports. So that will help him some. His bank will give him some extra leverage on that account. But still he needs more money, so where does he go? Well, him and his bank and the bank will together go to the Export-Import Bank. And that's because Ex-Im does not actually make loans. What they do is they guarantee loans that are made by existing banks. Now, they will provide a guarantee at a very high rate. 90% is the typical rate on a guarantee on an export. If you are selling something to a foreign government, to a sovereign buyer, that can go to 100% guarantee. And banks like this product, and because they like it so much, they're willing to advance at very high rates against this loan facility. For example, how often do you get any advance against work in progress?
Very rarely.
Yeah, I haven't seen it happen yet.
Well, and that's interesting because I always lobbied for the fact that a lot of work in progress can be closer to conversion to cash than some raw materials.
But
I can't
that
argue with
was always a tough sell to bankers.
Yep. Yeah, I can't argue with the logic, but the bankers seem to think some other way. It's the same thing again with open export credit terms. Again, under this loan guarantee, this loan facility, you can get some very high advance rates on the assets that fall into place under the loan. What can you do with the loan? Golly, lots of stuff. The thing I want to concentrate on this page is the third bullet point from the top, covering standby letters of credit. This is a big deal because if you are selling, say you're selling a machine to someone overseas, and you're trying to get cash in advance so you can build the machine. In the meantime, they come back to you and say, Jack, we want to see a standby letter of credit that we're going to use as a performance guarantee, performance bond. Well, you know that when you go to your bank and ask for that letter of credit, they're going to ask you to put 100% of that cash up front into a segregated account. And so you could potentially just go cash negative on a deal just that quickly. So that's one thing I want to talk about. We'll hit it on the next slide. Again, as Ex-Im Bank, this is about creating U.S. jobs. And so they expect you through this loan to have at least 51% U.S. content. And there are some other details to qualify, but a good place to start thinking, could this apply to me, is does your product have at least 51% made in USA content? And that could include materials, could also include labor. These loans must be collateralized, but here's the interesting thing. Work in progress and export accounts receivables, in other words, a contract to sell, can become part of the collateral. So to a large degree, these are self-collateralizing loans. I don't know where else I've seen this before in my history. This is pretty interesting stuff. If I'm a CEO and my working capital is pretty well tapped out, this is one way to really significantly enhance that working capital. The third bullet point here again gets back to a letter of credit, that LOC. Under this facility, if you needed to issue that standby letter of credit as a performance bond to a foreign buyer, the bank would only require you to capitalize that letter of credit at 25%. So you've got 75% of the remaining cash still free to go out and work with, to put to use. Last item here is the issue of delegated authority lender. There are certain banks that have delegated authority from the Ex-Im Bank. They can simply make this deal. And so what that means is if you're interested in one of these and you're talking with a delegated authority lender, you can get a deal made potentially in a few days. So it can happen very, very quickly. And I think that pretty well takes us to the end of the webinar today.
Well, the question I have is what role do you, Brad, serve in Ex-Im transactions? You know, we've talked about the designated lender. You go with your banker. How do you and how does Kinker-Eveleigh, what role do they play in an Ex-Im Bank transaction?
We actually play a lot of missionary work. A lot of the role is often that of missionary. People simply don't know that this stuff exists, and so we're going out and telling people, this is here, you can use this. In the case of somebody saying, well, I'd like to cover my receivables now with Ex-Im Bank trade credit insurance, then I'll go in and dig into the details. I'll actually, probably for most of the time, I'll actually even do the customer's application for them online. I'll ask them for some information. I'll get them going. We'll actually produce their applications online so they can go and look at it all the way through this process.
So on the trade credit part of that, you would be the agent and be compensated via commission. Correct. Okay.
Correct.
One other question I had: if you look at trade insurance and having a significant amount of background in the construction market, do you ever see many construction companies doing credit insurance?
The answer is used to be. That was before the last big recession hit.
Okay.
And since then, the trade credit insurance carriers have been particularly cautious about construction, particularly in the fact of people trying to be able to go back, subs trying to go back and be able to collect against a GC, general contractor. That's been the area of particular discomfort. If you stay away from that scenario, the answer is sometimes.
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 My experience has been that if you get into a dispute issue, it becomes rather messy, and I see that would be difficult to sort out, but I understand.
The disputes are often fairly messy, but I can say that if you are, let's just say that you're a foreign buyer, and you're working with an American construction company. If you have a dispute and are being very unreasonable about that dispute, when the trade credit insurance carrier comes in and calls on you and says, we have this dispute, we have this claim, that this American company has filed this trade credit claim against you, we need to get this issue resolved. If that carrier believes that you are being unreasonable, then you might not sit well going forward with other companies that want to cover you. In other words, a carrier will potentially say, we don't like these guys, we're not comfortable with these people, we don't want to cover them anymore. What would that mean? That would mean that as that foreign buyer, you may start to lose access to the very best suppliers. Do you really want that to happen? And you have to use some common sense in that perspective.
Okay.
So, yeah, you don't want to get on the bad list of these people.
I can see that. One other question that came up, if you have a customer that is designated for a coverage of, let's say, $100,000, and I think I know the answer, and you choose to extend to them $110,000, that extra $10,000, you're on your own.
You're on your own, and what you've actually done is you've actually increased the risk in the entire transaction. So if you're an underwriter, an insurance carrier looking at that, then you're saying, golly, this is now a bigger risk than we had ever planned on accepting. So now it's all at risk, and because it isn't just that $10,000 that's at risk, it's the whole 100 plus the 10,000.
Gotcha.
And so now our total risk bucket has just gotten elevated against what we were willing to cover before. So yes, as the customer, you can still choose to go ahead and extend that credit to them. But if you suddenly lost the whole thing, and the customer now didn't pay the whole thing, you might get less than you would normally get in your compensation.
Gotcha.
So there might be a small penalty for that.
Okay.
But yes, you can, if you choose to, you can indeed ship as much, you can take as much risk as you want.
Okay. Well, let me give the third CPE code, and that is the number 91. 91 is the third CPE code. And Brad, we're bumping up against the 1 o'clock hour, so I want to thank you for taking time to share this information with us today. I also want to thank everyone for taking the time to dial in and be with us. Remember, please send your evaluation forms that you received this week to Lynn Keenley. Your input for future webinars is very important to us. Our next webinar is scheduled for June 13th, and the subject will be grant writing. And thank you for listening in, and have a great day.